Right now, America has never been richer. Home prices, stock portfolios, retirement accounts, all sitting at record highs. By every number that matters, this should be the best moment to be alive in this country. But ask the average person how they're doing, and you'll get a very different answer. Consumer confidence is near its lowest point ever recorded. Lower than 2008, lower than the pandemic, lower than almost any point in modern history. So here's the question. Nobody in finance wants to answer honestly. How can the economy be breaking records and breaking people at the exact same time? I'm going to show you. And by the end of this video, you'll understand something most people never figure out. That the economy isn't one thing. It's two economies, wearing the same name, and almost nobody tells you which one you're actually living in. Let's start with the number everyone loves to point to. The stock market, up double digits this year. Records falling every few weeks. Pundits on television treating every high as proof that things are good, that the system is working, that if you just stayed invested, you're winning. Here's what they don't say. Roughly the top 10% of Americans own about 90% of all stock market wealth. Not 50%, not 60%, 90%. So when the market hits a new high, it's not really telling you the economy is booming. It's telling you that a small, already wealthy slice of the country just got wealthier. For the other 90% of people, that record high might as well be happening in a different country. Now here's where it gets uncomfortable, because the same thing is happening inside the most boring, most average account in America, the 401k. The average 401k balance just hit a record high, over $160,000. On paper, that sounds like proof the system is working for everyone, not just the top. But look one line below that headline, and the story flips completely. In that same record year, a record number of people were pulling money out of their retirement accounts early, not borrowing, cashing out, paying the penalty, taking the tax hit, just to get cash in hand today. About 6% of savers took a hardship withdrawal this year. That's roughly triple the rate before the pandemic. And when you look at why people were raiding their own future to survive their present, the reasons aren't luxury purchases, they're survival. 36% of those withdrawals were to avoid foreclosure or eviction, 31% were for medical expenses, 13% were just to cover tuition. These aren't people cashing out to buy a boat. These are people choosing between their retirement and their roof. So here's the paradox in one sentence. In the same year, the average retirement account hit an all-time high. A record number of Americans were forced to destroy their own retirement just to stay afloat. Both of those facts are true at the same time, about the same country. How is that even possible? Here's what almost nobody in finance will say out loud. Averages lie. When you say the average 401k is $160,000, you're not describing the average person. You're describing a mathematical midpoint that gets dragged upward by a small number of very large accounts. A handful of people with $2 million balances can make millions of people with $8,000 balances disappear into a number that looks healthy. That's not a flaw in the math. That's the entire trick, because the moment you stop looking at averages and start looking at the median, the number where half of people are above and half are below, the picture changes completely. The median retirement balance in America is nowhere close to $160,000. It's a fraction of that. For millions of working Americans, retirement savings aren't a cushion. They're barely a mattress. So when the market rallies, when home values climb, when the headlines celebrate a booming economy, what's actually happening is this. Assets are going up in value, and assets are overwhelmingly owned by people who already have money, stocks, real estate, businesses. These aren't evenly distributed across the population, they're concentrated, which means when asset prices rise, wealth doesn't spread outward to everyone. It compounds upward onto people who already had the most. Meanwhile, the people without assets, the renters, the paycheck to paycheck workers, the ones with a checking account instead of a brokerage account, don't feel a booming stock market at all. What they feel is the other side of the same boom. Higher rent because home prices are up. Higher grocery bills because input costs are up. Higher everything because the cost of living rises right alongside the assets they don't own. So the stock market goes up, and for one group, that's a win. For the other group, it's just inflation with better PR. Let's make this concrete, because numbers on a screen don't always land until you see two lives side by side. Take two people, same city, same age, same income even. One of them owns a home and holds a modest stock portfolio. The other rents and keeps whatever's left over from their paycheck in a checking account, because that's all they can manage. 5 years pass. The market climbs. Home values climb with it. The homeowner didn't do anything differently. Didn't work harder. Didn't get smarter. Didn't take some genius risk. They just already owned something before it went up. Their net worth grows by tens of thousands of dollars, quietly, in the background, while they slept. The renter, meanwhile, worked just as hard, maybe harder, but they owned nothing that was rising in value. So while the market delivered a raise to one person for doing nothing, it delivered a bill to the other, because their rent went up right alongside those same home values. Same 5 years, same economy, two completely different outcomes, decided almost entirely by one factor: what you owned on day one. This is the wealth gap nobody wants to explain, because it's not a story about villains. Nobody is secretly plotting this. It's simply what happens when an economy runs on assets, and assets are unevenly owned. The system isn't rigged in some dramatic conspiracy sense. It's just quietly, mathematically built to reward the people who already own things, and it does that automatically every single day, with no one having to lift a finger. That's why two people can look at the exact same economic data and walk away with completely opposite conclusions. The homeowner with a stock portfolio looks at record highs and says, the economy has never been stronger. The renter with a checking account and no investments looks at the same headlines and says, the economy has never felt worse. Neither one is wrong. They're just standing in two different economies that happen to share a border. And here's the part that should really bother you. This gap doesn't just sit still, it compounds. The person with assets this year has more assets next year, which buys them even more next year, which means the gap between the two doesn't stay the same size. It widens decade after decade, quietly, whether either person notices it happening or not. So where does that leave you? Here's the uncomfortable truth. You can't out-argue this gap, and you can't legislate your way out of feeling it personally. The only lever you actually control is which side of that border you're standing on. Every dollar you put into an asset, stocks, real estate, a business, anything that can rise in value, Elliot denies, is a dollar that moves you from the group getting squeezed by the boom to the group benefiting from it. Every dollar you leave sitting in cash while prices rise around you is a dollar quietly losing ground. That's not a hot take. That's just what the data has been showing. Year after year, boom after boom. The people who own assets ride the wave. The people who don't pay for it. So the next time someone tells you the economy has never been stronger, don't argue with them. They're right. Just ask them one follow-up question. Stronger for who? Because until you know the answer to that, every economic headline you read is only telling you half the story. And once you see that split, you can't unsee it. In the news, in your own bank account, in every record high headline for the rest of your life.